Hey everyone, it's Alissa Coram back with another IBD live clip for you, this time featuring stockmarketmentor.com founder Dan Fitzpatrick. And in this clip, Dan shares his take on managing portfolio risk. Check it out.
Traders tend to get more exuberant and more aggressive and happier when their positions are moving better, just higher and higher. Oh my God, I'm going to make up for all my stupid trades that I've made recently. And then what happens is they kind of get top heavy. It's like an upside down pyramid where you start with a good cost basis. And then as the stock moves higher and higher, you're buying more and more and more. So you're raising your cost basis at the same time as you're raising your position. And then all it takes is a 3% correction in the stock and you're going, oh my God, what have I done? So It's just really important to understand that, stick to your positions and always be focusing on the portfolio risk to those winning positions.
Right. That definitely makes sense. So what are your thoughts in terms of timing new buys? Say the stock itself checks all the boxes in terms of setup, fundamentals, technicals, where it is in relation to those moving averages, but the market is a little bit overheated, potentially. Sounds like maybe in your view, we're not quite there yet, but how does that impact how you're approaching adding new positions, that dynamic, index level versus stock level?
Yeah. Okay. Other than the stock, the big stocks that everybody's been talking about, Apple, even Amazon, Netflix, Nvidia, all of those things, because they're such heavy, like the NASDAQ 100 so heavily weighted in those, then you really kind of have to look at those in sync, because it just, that's kind of the way they trade. But we're kind of getting away from that right now. And I think that I'm choking on my words. I think that you really just need to focus on those stocks, because a lot of times you'll see the major averages doing something and a strong stock is going to do something totally different. And so just to be keying off the major averages like the NASDAQ or the S&P, you can really miss big moves in stocks. I think that the most important thing is your entry. Because most stocks will, I forget what Bill has said as far as what the percentage move, generally speaking, that a stock's going to make that's directly tied to the major market averages. But you're going to get some kind of ebb and flow even with those strong stocks. The challenge that people face is they take extended entries. Right. And this is what you're asking, Ali. They take these entries on extended stocks right when the market's extended as well. And this is what it sets up. When the market starts to pull back, there's going to be at least a pause in those strong stocks. And so what you've done is you've gotten yourself into this position where you've forgotten about what the potential upside in the stock is from here, rather than looking at just the downside. You have to balance the two sides of risk, the risk of missing upside, again, from here, versus the risk of losing money on a pullback. And if you get good entries, that question is answered really quickly, really easily. But if you're taking extended entries, you don't know when the stock pulls back or even when it pauses, you don't know whether you're just early or late or wrong. You don't know the answer to that question until the stock's pulled back quite a bit. So to me, it really starts with the individual stock as opposed to looking at the broader market and then trying to time your buys and sells that way. Generally, though, as they say, the rising tide tends to lift all boats. So when we're at high tide, you got to ask, well, how much more is my boat going to be lifted?
I hope you enjoyed this clip. Now be sure to subscribe to my channel so you can stay up to date on all the latest videos when they drop. I'm dropping about 1 to 2 videos a week, so you definitely don't want to miss them. Thanks so much, and I'll see you next time.